morning, everyone, and thanks for tuning into this webinar on how MGAs can succeed in a volatile world. I'm Dan King from Insurance DataLab. Before I introduce today's lineup of panelists, I'm going to turn to Matt Scott to talk about the key findings of our new research that was published just in time for last week's MGA Association conference. Hi, Matt. What's the research all about?
Thanks, Dan, and good morning, everyone. So this is our third year of analysing the financial performance of MGAs. Our analysis, again, is based on studying company accounts across three key pillars of performance that we believe are the strongest indicators of financial success. So these are growth, profitability, and productivity, with MGAs receiving a score under each of these pillars that are then combined to give an overall MGA performance rating. So for growth, we've looked at the change in revenues and profits over the last 12 months. Profitability is based on the 3-year aggregate EBITDA margin. And then for productivity, we've looked at staff costs as a percentage of turnover over the last 12 months, and also the turnover generated per employee over that same period. To be included in the analysis, an MGA needs to have filed full accounts at Companies House for each of the last 3 years, have had positive revenues in each of those periods, and also have at least 10 members of staff and disclose their staff costs as well.
Great. And what are the results telling us?
Yeah, so the headline finding really is that MGAs remain in a strong position, and they fared particularly well when it comes to growth. So the average growth rating this year stands at 55.5%, and that's after revenues grew by 25% over the last 12 months. While the rating is down slightly on last year, it was 55.7 last time around, it's still significantly higher than the growth ratings we saw in 2022, with MGAs continuing to report impressive levels of growth there. We'll hear from Mike from the MGAA later, but he wrote in our report that MGAs are no longer a hidden gem, and I think this continued growth really shows just how important MGAs have now become for the UK insurance market. Profitability has been a bit tougher, however. The rating dropped to an average of 48.6% this year, down from 50.5% last year, with the 3-year EBITDA margin average falling to 0.1%. That's down from 13.6% last year, but it's worth pointing out that this figure was skewed quite a bit by some significant losses at a select few MGAs, so that has kind of skewed the figures a bit there. Reassuringly, however, productivity remains strong, so the average productivity rating has climbed to 55.4%, up from 54.8% last year, with MGAs continuing to report improving levels of productivity. Average turnover per employee was the standout one there. It's now up over £164,000 on average, and that's up from less than £132,000 just a couple of years ago.
Okay, and what about individual MGAs? Who are the standout performers?
So yeah, we've recognised 6 MGAs this year for outstanding financial performance, and they've all significantly outperformed their peers. And each of those are receiving an Insurance DataLab Gold Award. Top of the rankings, the best performing MGA in UKGI is Volatile International, and that's with a market-leading rating of 75%. It's actually the second year running that they've finished first in our rankings, and the third consecutive year that they've won a Gold Award as well. We have a number of other serial award winners as well. So Euclid Transactional UK and MPR Underwriting have both won Gold Awards, and picking up one again this year. And then we have a couple kind of first-time winners in Castell Underwriting Agencies, Sutton Specialist Risks, and Optu Underwriting. So well done to all of those.
Fantastic. Congrats to all 6 firms. So how can people find out more about this research?
Yeah, so the report goes into a lot more detail around the overall market performance and what the results look like for MGAs of different sizes as well, according to revenue. And there's also an analysis of each of those top Gold Award winners' businesses, their results in the report. We sent it out in our last newsletter, but if you haven't seen it already, we'll be sending it out again next month, and you can also download it from our website. And then the ratings for each individual firm are available to subscribers on our Insight platform. We also provide tailored reports for non-subscribers that kind of compares and benchmarks performance of specific companies across across the pillars I mentioned earlier. And feel free to email me at matt@insurancedatalab.com or through our website if anyone would like to find out more about that.
Brilliant. Thanks for that, Matt. So now I'd like to introduce the rest of our panel. So please welcome Mike Keating, CEO of the MGA Association, Kate Albert, CEO of Kova Professions, and Tim Smyth, CEO of Bspoke Group. Hi all. Before we get started, I just want to say we would like this discussion to be as interactive as possible. So please submit any questions or comments you may have in the Q&A tab here on Zoom, and I'll put as many as possible to our panelists throughout the session. So to kick things off, Mike, as Matt pointed out, you said in our report that MGAs are no longer a hidden gem, and you're clearly very optimistic about their role in the market. Why is that, and what are you seeing as the big opportunities?
Okay, yeah, well, good morning, everybody. So if I start off with some numbers, so as an association, we have in excess of 230 bona fide MGA members across UK and Ireland, and we also track a number of MI through our members, which includes premium income. So the combination of the premium income which those members actually place into the UK and Irish market is in excess of £13 billion. Okay, so that is an absolutely huge amount of premium income, and clearly that is a testament insofar that, number one, that insurers have got so much confidence in terms of deploying capital to experts in niche and specialist products. Secondly, it obviously shows the confidence of the broker community for those MGAs who deal with brokers, in addition to those MGAs who actually deal with the consumer from that perspective as well. So why am I sort of so excited, and why is the sector so buoyant? You know, there are a number of pillars which MGAs have consistently performed, as shown in your research over the last 3 to 5 years. And just before I touch on those, there's probably something I'd like to highlight. You know, we have over 60 insurer members in the association, and I speak to them very regularly. And the question I ask them is that how high is their confidence in terms of the professionalism, underwriting expertise across the MGA community as of now? And I would say that to an individual company, they've all actually sort of endorsed that they've never seen the professionalism, expertise, rich data, agility, you know, product innovation. They've never seen it so high, which I think is a real testament in terms of where the MGA sort of community is both now and in terms of its trajectory. But just sort of briefly, if you look at, you know, MGAs are increasing their share wallet with brokers. You know, their sort of relationship with distribution is so forensic, and they have the agility to actually change and introduce new products far quicker than sort of general insurers. And that's not a criticism of insurers, that's just the case that they're big tankers. The speed to market on products, therefore meeting brokers' clients' needs, which are absolutely critical from that perspective. So that's sort of one real key area. The ability to, again, to concentrate in terms of niche and provide differentiation, again, for brokers is what is needed, is something, again, which they're absolutely sort of really expanding on and will continue to expand on in terms of new products. And if you look at opportunities, you know, I think one of the areas which I think is sort of a greenfield site, and it'd be really interesting from Kate's and Tim's view, is around operational cost. So if you look at operational cost, you know, the area I would see is a real sort of an area of development is, you know, the use of technology to actually automate sort of data both from brokers back offices into MGAs and vice versa, and the same case from MGAs into insurers. And that would be through a case of using APIs, you know, complementary AI from that perspective. Because the more that operational and frictional cost can be removed from that sort of ecosystem, then ultimately that will be better news for the end customer from that perspective. And also it allows MGAs in particular to focus on what they're absolutely experts at, which is actually underwriting. So you know, to me, it's as buoyant as I've ever seen it, frankly.
Great, thank you. And Kate, you recently launched a brand new MGA in the form of Kova Professions. So what drove you to set up the business, and what are you bringing to the table that's different?
But I think it actually leads on quite nicely from some of the points Mike just made, actually. So we did see some significant gaps in the market. I mean, my background, I've worked at some large multinational insurers beforehand, and also spent some time at the FCA before I came back into the MGA market, heading up an underwriting team there. But whilst I worked there, I saw some gaps in the market where we saw some sort of slow response times, perhaps generic one-size-fits-all approaches, and brokers were facing quite a few pain points in that area. So I thought it was the sort of ideal opportunity to come in and be a more sort of agile MGA that's operating that space. We look at the mid-market sector across the UK offering PI products, and our focus really is to look at sort of rigorous underwriting and risk management to offer solutions to brokers and responses, because actually I think we see a lot of research that's coming out where brokers aren't really getting good response times. So we're coming in with sort of more agile. They've got direct access to decision makers at Kova. So we have a team currently of 3, about to be 4. Each of us has around 20 years experience. So we have that sort of strong understanding of the market, our products, and what we're offering. We look to sort of collaborate quite strongly with our brokers, working with sort of a key panel of around 10 to 15, rather than trying to spread ourselves too thin. We also have a start to end system that helps us. So we have that technology that has a platform built in. So actually we're enabling ourselves to sort of quote, bind and issue policies quite swiftly, because I think actually as technology grows that you need a bit of investment in that technology to be able to obviously give your products out to market quickly as you can. And we're also, because we have that agility, we're able to, and access to decision makers, we're actually able to evolve our product to customers' demands and needs. And that's not saying that we're actually going to stray away from our core values or our business understandings. It's just the case that if something needs to evolve and change, brokers are able to speak to us and a decision gets made by our team, rather than having to refer it perhaps up the chain further or even to a different country to be able to make that decision. All the decisions are made by the team in the UK who have access to us. So I think it's one of those things that we look to address some pain points, and then we're looking there to be collaborative with our broker and to grow with them.
Yeah. Okay, great. Thanks. And Tim, Bspoke Group obviously rebranded last year. It's been quite a turnaround from the UK general days. Can you tell us a bit about what's different now and what the future holds for Bspoke?
Yeah, no, thanks. And good morning, everyone. And thanks, Dan and Matt, for the opportunity to come onto this webinar. First thing is, it wasn't just a rebrand for UK General. It's the name that everyone seems to remember and reminds me of. It was a group of complementary businesses that were all branded differently. We bought from our previous shareholder in an MBO that we completed in 2020. 22, and we were keen then to sort of give it one identity. A number of reasons for that. I think first and foremost, the brokers, we have the ability to trade in any one of our 7 verticals with any broker across the piece. So if they have access maybe to our private clients business and they want to then deal with some freight or some commercial business, that they can work with different teams knowing that they're covered under the same toba. I think also with our carriers as well, we have an approach where we have very much a portfolio approach with our underwriters, that we want to give them a balanced book of business. I think that's easier for us to manage a sort of long-term expectation of an underwriting result, where you're not committed to one particular product in one particular market, and give it that balance. So I think, we are now 14, 15 months after the rebrand. I think that's certainly put our visibility a lot higher. Recent acquisition or Police Mutual will not be rebranded, I should add, but very much part of our family of sort of niche and specialist products that we have. What's for the future? More of the same. We see almost endless opportunity to roll out new products that are niche and specialist, to bring in really talented people. There are lots of opportunities there to bring in more talent into the business, trade on our big relationships now that we have with carriers, and they're getting so much better at rolling out and working with products to get products out much quicker than we've done in the past. And that's a two-way street. It's about us being prepared, putting a big proper business case forward, but also their support and their engagement, and particularly where we're seeing and working with carriers that are very much back in MGAs. They really get it, and we know what they want, and we need to deliver that quickly. And I think all brokers end customers and ourselves will benefit for that. So we've got more hires, more teams, individuals, definitely more acquisitions and several on the go at the moment that are more of the same, and continue to build on the relationships that we have with our very supportive carriers.
Okay, thanks. So I think we can all probably agree that MGAs have a very bright future, and our research kind of really backs that up. But there are obviously going to be some challenges too. So Kate, as the new kid on the block, so to speak, what challenges are you facing and how are you dealing with them?
Well, I mean, we are an extension of our capacity providers, really. So some of the problems that MGAs are facing are also the sort of larger insurers are looking at as well. So obviously the economic uncertainty at the moment, especially with perhaps the change of government, where we're looking at increased claims costs and then how the markets are going to evolve to price their products. So they're obviously still competitive, but able to face those costs. Obviously, there's changes in regulatory and compliance, which hopefully I'm on the front foot of, having worked at the FCA and I've got a master's in regulation and compliance. So I try to stay quite ahead of the curve on that sector. But as we saw at the MGA event last week, where Lisa Sturley spoke, I think there's MGAs have perhaps been maybe slightly forgotten by the regulator, whereas I think the focus is looking on sort of those relationships and how they collaborate with their capacity provider to make sure that obviously everything is done correctly within the UK space. So I think MGAs need to be quite aware that they're obviously pairing up with the right capacity. Technology, again, is a big push, so we need to make sure that you're kind of ahead of the curve there. I think that's something, having strong technological platforms does help you respond to the market a little bit quicker and offering a product to them quite quicker. But again, obviously that technology can lead to cyber security threats. So you have to be careful that obviously those people that you partnered with to develop your platforms have actually got that strong, robust system where it's been penetration tested, and that you're aware you're not exposing yourself to data threats, especially because you're carrying a lot of potential GDPR issues. Obviously it'd be a bit remiss to not mention obviously the softening market conditions. So as a new entrant, actually for us, because we have no back book, that gives us an opportunity to be able to come in, as long as we're not deviating from our technical rate, because we do have like strong, rigorous risk and pricing practices. And actually it gives us an opportunity to pick up new business as a new entrant. So for us, it's quite an exciting time where we don't have to really have too many concerns around the retention. I would say for me, it's been quite something that I'm incredibly proud of. I've only been launched since May, but I have a strong team around me already that have believed in the value proposition of Kova and my business plan. So that's been great. My two underwriters are on board already. One came from Torbert, another one from Access, and a third is joining me from RSA. So we've been very strong in developing that talent, which I think is something that perhaps MGAs really do need to focus on. And I think where a lot of us are kind of operating in that space where we do have quite experienced teams, I think for me, something that I do want to start nurturing going forward is that younger talent coming into the MGA space, because I think that might be something that's been underserviced for quite a while, perhaps where that flexibility of working is coming in. But I'm very supportive of sort of youngsters coming in and giving them that sort of that completely sort of that training that they need to be able to come on to be the next generation of the market. But again, I think for me as well, my main focus, and it's one of our KPIs at Kova, is to be really strong customer focused, be it the sort of broker that we're dealing with or our end consumer. And again, obviously consumer duty is a massive thing that's coming in. So we're making sure our products are suitable to market, and obviously that regulation and compliance has all been done and is right.
Thank you. And Matt, Kate refers to some of the things that's going on in the world, the volatility, the uncertainty facing MGAs. In your view, what challenges does that present for MGAs?
Yeah, sure. So obviously, we're still in quite challenging economic times, as we've heard, a lot of uncertainty going on with new government here, kind of the US elections coming up, and the various conflicts going on across the globe, all contributing to create quite a challenging environment. And as I said at the start with our research, profitability has come down a bit, so there is going to be kind of challenges ahead. And as Kate said, while we've been used to, I suppose, a hardening market in recent years, rates are starting to come down now in many business lines, and that's going to apply a bit of pressure on profitability at a time when maybe the profits have dropped slightly already. Having said that, MGAs are continuing to grow, and that's a great thing. But with continued high claims inflation, cost of regulation having gone up recently, there needs to be a real focus, I think, on keeping costs down. Technology, as Mike and Kate said, will play a big part of that. And I think it's important to adopt that in the right way. So as well as helping with kind of processes and costs and efficiencies, it also helps that end customer. I think you need to always have that focus on what the customer needs when implementing that technology. But ultimately, you also need it to help keep down that loss ratio and make sure you're still essentially delivering profits for your insurer partners whilst growing that book, because you can't just focus on growing premiums and growing your book size, winning new business if it's not delivering that profitability. So it's a balance in maintaining that growth while also making sure profitability remains steady and you're still delivering those results for your insurer partners, I'd say.
Okay, and Mike, what pressures kind of do you see as a softening market creating for MGAs and some of your members maybe, and how are they best dealing with that?
Yeah, I think I think people on this call and all of our members that the thing it's not a cliche to say that you have to look after your capital and capacity. At the end of the day, you're using their balance sheet to buy in business. You want as much autonomy as you can, and as Matt's alluded to, and Kate, I'm sure Tim will agree, you want to provide long-term underwriting profits over the cycle from that bit. So if you're looking at a headwind, which effectively is a softening market where rate adequacy as opposed to rate reduction is now becoming under scrutiny, then effectively from an MGA perspective, I'll go back to my own experience, it's how flexible your model is in terms of being able to navigate and ride through where there is actually a reduction in rate adequacy. Is your technology able to absorb some of that potentially reductions in retained revenue because premiums are reducing? Is your fixed costs too high, or is your fixed cost not so high that you've got some flexibility actually to absorb some of that, again, revenue reduction in terms of your P&L as an MGA whilst that soft market is actually going on with a view, and naturally is what tends to happen is that we come out of that where there's more greater rate stability from that bit. And I think again, it won't be a surprise, the worst thing an MGA can do when the rate adequacy is reducing is to effectively try and grow their way out of it, because the market is littered historically of where MGAs have tried to do that and effectively delivered very poor underwriting returns. And the reason they've done that probably is because some of their models, their P&L models, have that flexibility to absorb those soft market sort of impact. And if that happens, then effectively capital will withdraw from that bit. But as I said earlier, I believe the MGA community now has got enough muscle memory in regard, how to navigate softening market where their models are agile, where they'll see their way through. But fundamentally, everything Kate said and Matt said is absolutely right. But what you cannot do is effectively, expose your capital provider's balance sheet to sustainable poor underwriting results because you're trying to grow through a market where rate adequacy is actually decreasing.
Okay, thank you. Yeah, Kate and Tim, you're nodding there. Is there anything you wanted to add to what Mike's just said there about the challenges and how to handle the kind of the soft market?
Yeah, I mean, for us, obviously, we're a new entrant, so it kind of creates, for us, obviously, it's creating some new opportunities for us to be able to come in, and so we're quite well positioned to perhaps leverage some of the opportunity that's coming in with the softened market. But I think that doesn't mean from deviating from your business plan, your underwriting standards, your sort of rigorous underwriting and your performance, because as an MGA, you've kind of entered with a business plan that you need to be robust and stick to, because obviously we come in as perhaps niche players or an extension as their capacity providers offering a service maybe they don't offer themselves. So the point is to try not to, even if you want to grow, but stick to what you're good at as well, because that's how growth works. And there's no need to really sort of drive down premiums and drive down the market, because I mean we've been in that experience before, perhaps in 2018 when that happened. So I think it's about sort of maintaining those robust standards and doing what you're good at, and then the market does obviously shift as you're coming in through that, and then obviously the cycles turn. But I think there's no need to kind of deviate from your robust underwriting.
Okay, thank you. And yeah, Tim, anything to add to that?
Yeah, look, I agree with everything that Kate and Mike and previously Matt said, really, that discipline is really important. And I think when you look at your shareholders, you know, they need to understand that we're in a secular market where, you know, profitability ebbs and flows depending on the availability of capital to underwrite risk. And I think if you've got the wrong shareholder partner that's only interested in a return for the MGA without any, you know, care about what happens to the underwriting capital, it's going to be a pretty short venture. And, you know, I've been in that situation before where you're having to, you move capacity quickly. It creates a lot of friction within the business. And that, as a manager of the business, is a huge distraction. So I think, and I'd like to think that most of the larger and more successful MGAs now have a much longer view in terms of the cycle and how they manage the way across that. But the investors in the business need to understand that it's not a one-way street with ever, you know, a hockey stick of profitability being delivered out of the MGA with, you know, just no correlation to what's happening in capacity. So to Kate's point, you need a plan, you need to stick to it, but you also need to understand the impact that has on your P&L and what capital you might need to bring into your business to be able to see yourself through that cycle and onto, you know, better times.
Okay, thank you. Now, just a reminder to everybody that's tuning in, this is your opportunity to ask questions. So please do, if you've got any questions, and I can see there's a couple that have come in, but use the Q&A tab on Zoom, and we will answer those questions if we get the time. We'll certainly put some of them to the panel. And if the questions are aimed at anybody in particular, then please also do put that in with the question. But just moving on back to you, Tim, actually, one of the lines of business that's faced, I suppose, some well-documented issues of late has been high net worth. And I know this is an area that Bspoke's been expanding into. So just interested to know what was behind that decision, and what do you think you can do differently to achieve success here?
Yeah, I mean, really extending the point that we've just been talking about. So, you know, if you're in one product, one vertical, and the market starts to soften, as, you know, Kate talked about, and if business isn't going to hit your plan, you have to then reduce what you're writing, and then, you know, you've got a different outcome. We've taken an approach. We have, you know, 85 different products now across the group in 7 different verticals. And we know that within those products and verticals, we're going to get different cycles. You know, there's a general capacity, secular movement in terms of availability, but we try and look into that in a bit more depth and see where are products that have got dislocation. We saw that with PI. We started a PI business when the markets were, you know, extremely dislocated. Opportunity was good, and we now watch with interest how that, you know, is managing into a softer part of the cycle where discipline is obviously absolutely vital. And we see the same with high net worth in particular. A lot of people have left the market over the last 12 months or so. We see an availability of talent that, you know, we really want to grasp. We've had brokers who engage with us on other products, but also specialist brokers who say to us, look, the bespoke approach here, this is an opportunity to build on a turning market condition. So we're investing now, realizing that the high net worth in particular is probably quite dislocated, but we're confident that we can write a portfolio that deliver the returns that are acceptable for our capacity providers and really start to build a sizable business. And that will continue, I suspect, for the rest of this year as we look for more talent, more opportunity. We've got some great capacity on an exclusive basis. It's really exciting, actually. We kind of take the contrarian approach. And that means then in other areas where we're not as convinced that rating is as strong or that we can make the returns, that we're not putting ourselves under unnecessary pressure if we have to maintain a portfolio or even reduce it, which we've done significantly in the past. We can maintain an overall profit on our portfolio, and as we place with capacity providers, I think that will give them the return that they're looking for. So yeah, and I think the other point about, you know, high net worth is, as the rates have become much softer over the last couple of years, it's been much more difficult for insurers and MGAs to deliver the service that clearly the end clientele are looking for. You know, the brokers have geared themselves up to deliver a very high level of service, but if they're not getting quotes back from capacity for 2 or 3 weeks, that's not really going to look good on them, despite it not being their fault. So, you know, we're very much on the front foot on service. We're investing in technology, more people, and making sure that we're very responsive. And I think what's grown our portfolio, particularly over the last 12 months, is that ability to turn quotations around really, really quickly. So yeah, no, we're delighted to continue to build this element of the portfolio out.
Okay, thanks. And Mike, do you have a take on what some of the challenges around high net worth might have been about?
Yes. So I suppose my view is around, coming to the point around business plan, is that I think first and foremost you have to absolutely have clarity on what you include as high net worth. Okay, so what is that box in terms of risk profile for which you're saying that as a high net worth customer, that's a high net worth product as an MGA, that's how we're going to price it. And when you price it, you look at in terms of what your claims frequency is going to be, your average claims cost. On top of that, in terms, as Tim says, around the service you deliver. I think one of the areas where they are not collectively, it's actually failed, is that there have been high net worth products which have been aimed at mid net worth customers. And when you look at that, then the behaviour for mid net worth customers around claims, propensity to claim, average claims cost, etc., is completely different in terms of your composition of your ULR than if you're looking at that high net worth area which Tim has just articulated. And I think if you ask capital providers and if you ask some of those MGAs who unfortunately have sort of exited, they would probably concede that it's where the definition of what high net worth and all the components around heads of cover, all what I've said around frequency, average claims cost, has not actually, because of the profile of customer written, has not met that. And those areas have been far higher, both in frequency and average claims cost, which has meant that the underwriting returns have not been satisfactory. So I think if you stick to, and you've got, I know that Tim will do this because he's got a very experienced team which he's pulled together. If you define in terms of what your high net worth customer is, and then you work through your experience all of those ULR compositions, then you can be successful. And I think it's a great opportunity for an MGA if they stick to that and have the discipline, to use Tim's word earlier, in terms of remaining in that space and not dropping into sort of necessarily mid net worth.
Okay, yeah, thank you. Now I'm going to deviate a little bit and just go back to our audience because we've actually had a flurry of questions suddenly. So I'm going to just pick a few of these out. If you put your name against the question, I'm going to name and shame you. So Paul Martin has a question talking about data quality. So he's saying that everyone talks about adapting. The biggest hole that we see, I don't know who he works for, but the biggest hole we see is the quality of management information to drive the business for both underwriters and carriers. He's saying the quality of the data they get is generally pretty shocking. And he says here, especially when premium income is added to claims data from TPAs. So he said he's worked with Tim's team for the last 3 years or so, and the results have been amazing. So good Bspoke group. But he said you really have to work through it and invest in getting the right data. AI can help partially, and it's just a general question he has for everybody. Really, just any thoughts or comments on that. So basically, talking about data quality.
I think it's not just the quality of data, Dan. A good question, Paul, as well. I think it's the speed at which we get that data. Historically, the lag that you've seen in how MGAs have collated premium and claims has just been, some cases 90 days. And, we have quite a lot of our businesses on a delegated model. So we're not seeing necessarily what distributors have been writing for, certainly when I joined here, a 3-month lag to not know what you've written. You try and manage sort of consumer duty and good outcomes for customers when you don't know what you've written for 3 months is quite a challenge. That's the first side. And secondly, I think the service from claims TPAs has been mixed. I think there's been heavy acquisition and a mixed service that's been delivered. And now we would only work with the TPA that can deliver us claims the next day on all our cases. So what we're looking to work with is more people who can deliver premium cases and policies bound the next day, and also claims as well, so that you get a real-time view. So it's no point having great data, but 3 months in arrears if you're then trying to make decisions around the not just the outcomes of your policies, but the profitability as well. So it's timeliness and quality.
Okay, thank you. I'm going to go through a few of these questions and just maybe ask one of you at a time to answer a particular one. So Mike, I'm going to turn to you because a question here from Tony Willis, which says, if you meet an individual at a carrier that perceives MGAs, either from US or UK models from the early 2000s, and is reluctant to use MGAs or to work with MGAs, what's your, he says here, your 60-second response to persuade them to change?
I think it's probably the quality of the business plan. Okay, so I would immediately show what is a 2024 answer to saying what's a 2024 MGA business plan, and obviously if you think about what Kate has talked about, she's got one very up to date, and compare that to what was a 2000 year 2000 business plan. That would be my sort of initial sort of response, and that would be absolutely chalk and cheese. And the first thing I could tell you, without a doubt, the 2000 business plan, after the introductory page, would then have a slide about how fast the MGA is going to grow, right? Where 2024 business plan, that will be at the end of a presentation, and it all will be around underwriting risk appetite, underwriting expertise, and how that they're going to ensure they're going to deliver back to the capital. So that hopefully that's a 60-second response for Tony.
Great, thanks, Mike. As we're talking about capacity, let's stick on that subject for a bit longer, because it's an issue that always gets discussed in the MGA world. Tim, what do you think the landscape looks like currently for securing capacity? Because I know from previous conversations that you think it's a bit different for new entrants compared to the more established players. Is that fair?
Yeah, I mean, look, we've had, and in my own personal experience, we've had some challenging capacity issues in the past, and that creates all sorts of uncertainty for your employees, your stakeholders, your policyholders, and that's not a way to build a business. And I think knowing that you have to deliver a good outcome over a long period of time for your capacity provider, and having a sort of aggressive transparency in terms of what's in it for both sides is hugely important. And I think, Mike and I have traded together for a long time, and I think I was smiling there when he was talking about what it was like in the year 2000. I remember doing exactly. I didn't think we had a second page to the business plan, Mike. So, the things have changed incredibly, much more technical in terms of outcomes, being very upfront with what a good outcome is for both parties. I think both sides being very transparent with their P&L costs, their expenses, and I think working together to create a model that delivers an end result that is right for all parties. My feeling is that we're all a lot more advanced in that now. We've, going back to my point about not wishing to move capacity providers, I think since we started this in 2020, we've not lost a capacity provider, and that's meant that we've had the time to focus on branching out into new products, doing more acquisitions. It's not been distracted by the extra point or two that we might have tried to get from our carriers, but then putting those relationships under peril, but really to build up that portfolio approach, and that's been really, really important. But the expectations about what we need to deliver in terms of data analytics, we have our own pricing team, reserving team, it's the expectation of what we're able to deliver. I think Mike addressed it very early on this call, is that the market has just moved on a long, long way. The technical ability of businesses like Kate's, where she's starting out, already has a great deal of technical ability, is now very much a given.
Yeah, and actually, Kate, turning to you, as a new entrant to the market, how difficult did you find securing capacity?
Well, I think we were in the position where we worked very closely with Mission Underwriting. They're one of the MGA incubators in the UK market. They've been around for about 18 months, 2 years now. So for us, I mean, the initial meetings with them, I had to go with a strong, robust business plan, underwriting guidelines, and a clear focus of what I wanted to do. So actually, before you even engage with those conversations with any capacity provider, they help, and obviously they whittle out the fact that your business plan is strong enough to do that before you even have those conversations. And for us, Mission sort of help support that 5-year capacity deal, and that's a rolling capacity deal. They help provide sort of a platform and all these sort of other work around us before and then it leaves us to be able to do the underwriting. But obviously, as we said, as a new entrant, we had to have a very strong, robust business plan, and very much echoes what Mike said. Actually, my financials were on the last page. The first few pages were what's happening in the market, where we see the opportunity, what I expect to be underwriting, where I see each class going, sort of the regulatory landscape and that, and some overview of it. So it's you have to be very strong and robust in what you're doing and have that clear message, and also have that expertise to be able to deliver that message and to work with them. So I think that's probably, again, alluding back to the question of how things have changed since 2000, is actually they expect that robust business management plan to be there, and they expect sort of your not only your knowledge as an underwriter to be up to date, but to be able to deliver that plan.
Okay, and Mike, there may be a very obvious answer to this question, but I'm going to ask it anyway. Because how important is it for MGAs to build strong relationships and partnerships with their capacity provider, particularly given that in many circumstances it can be withdrawn at relatively short notice?
So I'll probably make two observations on that. So because I think Kate and Tim have well articulated in terms of the importance of partnership. I suppose the first observation, again, where I think the optics have slightly changed, is that what you find now is that MGAs are now, not arrogantly, but very, very confident in their own underwriting expertise, that they are effectively, I suppose I'll use the phrase, interviewing capital, when previously capital was only ever interviewing MGAs as whether they're going to deploy it. So that is an absolute partnership approach, where MGAs now have that confidence where if they talk to different capital providers and don't feel that it's going to be the right fit, picking up on Tim and Kate's observations, then they're quite happy to move to somebody who they feel will be the right fit, because they're so confident in delivering sustainable sort of underwriting profits from that bit. The second area, which is something which I and the association are doing some work on, is your point around what I call capacity being withdrawn at short notice. There are far too many, and we're doing some work with our insurers and with the LMA, there are far too many what I call 90-day termination clauses in contracts. Now, it doesn't need me to say from my own MGA experience, and I'm sure Kate and Tim would agree, with the best will in the world, 90 days to exit and onboard new capital with all the due diligence which is required now, and quite rightly within a capital provider, all the stakeholders who need to come to the party and be ticked off, 90 days is just absolutely unachievable. It's absolutely unachievable. And my view is that should be a minimum of 180 days, which is something as an association we're working collaboratively with to try and sort of get introduced as best as we can. And the other point I would add to that, and again, you have to look from a consumer duty perspective, that if you have 90 days, is that really right and aligned with consumer duty? And I would question that it probably isn't. So, I'm not saying that, everyone is at 90 days, because there's many that you can negotiate and have a conversation around 180 and maybe even notice periods above that. But anything around 90 days is extremely dangerous for both the capital provider, the MGA, the broker, and critically the end customer. So that's something as a market, I think collectively we need to come together and try and resolve.
Okay, thank you. Matt, well, turning to brokers now, I guess. What do you see as MGAs offering to brokers that's a bit different to the traditional insurer route? And what do you see as the benefits for insurers in partnering with MGAs?
Yeah, so I suppose the first one really is it's all about that underwriting expertise that MGAs offer. That's probably the key one. I know you do get some generalist MGAs as well, but I think the real value is when it comes to specialist markets, whether that's the type of product being offered or the target market in terms of the end customer. It gives the insurer access to markets that otherwise would be hard to reach. And it also allows them to diversify their book of business further as well. I think MGAs, as we spoke about earlier, they're a lot more agile. Mike spoke about the great speed to market they can offer, not being burdened by those legacy systems that the insurers tend to have. And I think on the broker side, that allows fast decisions and to deliver excellent service as well too, which is great for the broker and also the end customer. I know kind of we see MGAs regularly outperforming insurers in the various service surveys you do. And I think that's a lot down to the I suppose specialism and expertise that they have, and also their agility and the way they can use technology. I think that's the key benefits there, really.
Thanks. So, Mike, do you think there's any other reasons why, other than what Matt said about why MGA service levels appear to be so much better than insurer service levels?
Well, I think Kate touched on it actually. I think I would argue that MGAs are far more forensic with their distribution. I think they've probably got better distribution data. I think they know if it's brokers. I think they know the brokers' makeup of their portfolio and where they can assist and get that share of wallet. I think there's very much a cause and effect from MGAs insofar that brokers are dealing directly with the decision maker, a decision maker who can work with that broker around changing the program design to deliver what that broker needs for the customer, which is even more sort of elevated in challenging economic circumstances where the end customer's finance director may be needing to have a robust insurance program, but maybe at a different sort of price. So that's where an MGA can do that, which effectively insurers, and let's be fair, insurers are trying their best to do that, but they don't have that speed and that agility to do it. And we've seen many broker surveys who get frustrated that they get bounced across different individuals where they have to represent the presentation again, as opposed to getting an immediate response. And no doubt, I know for a fact that Kate has already mentioned it, and I know Tim's business quite well, that they have frontline underwriters who have the authority and the expertise to make those decisions, which allow the brokers to do what they want to do, spend more time with their clients and meeting their clients' product needs. So it's just the DNA of an MGA model.
Okay, thanks. Now, one thing we haven't talked about, which obviously is a huge trend that everybody's talking about, is AI. Somebody has asked a question about AI, which I'm going to read out now. Peter Ratcliffe. He basically says, with AI and other emerging technologies significantly shaping business opportunities in the MGA market, specifically with the lens of creating savings on operational costs, can anybody share how basically AI is being used in this area in your businesses? So I guess really it's for Tim or Kate. Do either of you have anything to say about how AI is helping you to create savings?
I mean, for us, it's something that, again, we're new, so we're trying to be quite focused on technology and the platform we have. But it's something I would say as our business evolves and it adapts. I've seen several demonstrations of using AI to look at claims, and that's a really interesting area that I think at Kova we're really interested in pursuing and looking into more. So at the moment, I think it's being used for a little bit of sort of more generalist claims and sort of maybe the personal lines and motor, where actually you log a claim and then that AI bot can go through and log things and go through all the data to drive things quite quickly. And I think that's quite an interesting movement in the insurance market at the moment, especially where we're seeing potential costs going up. If we can look to save claims costs in the fact that AI is doing some of that work, perhaps when it's the first reporting, obviously you still need a person to go through that's kind of legally trained rather than just relying on AI. But for me, I think that's kind of a very interesting space at the moment and something I'm really keen to keep an eye on.
Okay, thanks. And Tim, anything to add to that?
Yeah, I mean, a bit like Kate, we're looking at a number of technologies at the moment and deciding whereabouts in the business that they have the best fit. You've got to bear in mind we do everything from selling directly to consumers all the way through to writing big commercial risks, and different applications will have different benefits throughout the group. I think there's probably a lot of hype in the market about everyone talking AI, and trying to get their investors excited about the business. I've not really seen. I've seen some good claims demos, but I've not really seen much that has actually been put in practice and is delivering those sort of savings at the moment. But I suspect that over the next 6-12 months, we will definitely be adopting one or two in one or two different areas.
Yeah, and a little birdie's just told me that the MGAA might be doing a little research project on AI. Is that right, Mike?
We may well be doing that, actually. We may well I suppose my observation is, and we had an excellent panel at our conference last week. I think if there's any messaging or takeaway I would sort of provide to this webinar audience is that before you invest even £1, in anything AI, ensure you know exactly what you want it to do, right? Number one. So do not go off without having a real in-depth planning in terms of what you want AI to do. That was a very, very clear message. Secondly, again, another key message that if you haven't got the data, then AI is a waste of time. So you have to have the data and the quality of data. So this is all in the planning pre-investment stage. What do you want it to do, and have you got, or have we got the data in order to have sort of compatible or complementary AI to work in terms of our ultimate gains. And you speak to, we've got many supplier members who are very adept in this area. And they will also sort of share stories where people have invested without at least doing the first two things I've articulated in terms of what do we want it to do, what's the benefits, what's the advantages, what potentially are the pitfalls, and most importantly, have we actually got the data to actually make the AI work? So that would be my sort of two observations in terms of from AI.
Okay, great. And another question that's come in from Claire Carpenter at Greenkite. So Claire's basically said, Mike, to your point, a great point around the target market and the impact it can have on underwriting performance if you get that wrong. And the question she asks is how much detail are firms really going into in order to establish the underlying demographics of the target customer base? So Claire's saying that she's seeing that some MGAs aren't really being, I suppose, defined enough in terms of the target market for the products they're offering. Now, I'm guessing in Tim and Kate, in your cases, that's not the case. But is there any kind of general comments around that from anybody here?
I'll pass the mic to the two guys who are running live MGAs. I think they would probably be best placed to respond to that.
I mean, I think in our direct experience, creating products that are clearly defined for a set target audience delivers better results. End of. If I look at the underwriting results and the retention levels of police and military portfolios, for instance, which are very specific, they are consistently much, much better than what we see in the general marketplace. And I think, for me and our team, looking at general products, and I think is sort of general commercial combined as for me, one of the most challenging marketplaces where there's little differentiation and, sector specific differentiation. It's very hard for us to compete with the big insurers. And therefore, that's really driven our strategy more into the periphery around very specific distribution and very specific niche products.
Okay, thank you. And a few questions have also come in around M&A. It's not something we've obviously spoken about really. I know, Tim, you mentioned about, you've got some plans on the acquisitions front. So I'll just read out a few of the comments and questions that are coming around this. One person said, with so much kind of M&A activity going on, do you see this as an opportunity or a challenge for the MGA market? Another one has said, many larger brokers are looking to acquire MGAs with a view to grow and develop the business further. Do you feel this could benefit the MGA market? And another one is actually referring to a very similar point as well, talking about how M&A in the MGA space, in the MGA space is getting more and more prevalent, and it's kind of starting to mirror the activity we've seen in the broker market. But I suppose, Tim, as you're the one that's talked about acquisitions, is there anything you wanted to add to any of those comments?
Yeah, I mean, I would agree. Activity is certainly stepping up. I would always have reservations about brokers wishing to buy underwriting businesses unless there's a very clear separation of duty. We are an independent underwriter, and our duty of care is to our capacity provider, and we work with independent brokers, and we're not tied to anyone. I think that's been a very important part of our development. Some of the bigger entities that have both MGAs and broking businesses, I know, go almost at lengths to make sure there's not too much trade between them, so we can call that out. But I think, mid-sized, smaller brokers buying MGAs simply to just put an extra link in the chain, it is not going to be a successful long-term strategy. There's definitely a lot more opportunity out there. I think, unlike buying brokers, where typically the consolidation model has been buying in single-figure EBITDA multiples and then sort of consolidating the whole piece and getting, teen sort of multiples based on simply the size. Broking is a very much a sort of two-dimensional piece there. You own a customer, you place it into capacity, your job is done, and you move on to the renewal. MGAs, as we've talked at length today, is much more around delivering long-term capacity, profitability. And therefore, the first thing we're always looking at, the first question we look at in any M&A, and we've got quite a few on the go at the moment, is understanding the underwriting process. What have the results been historically? What risks does that bring to our carrier that we hadn't got before? And does that make, a good fit in our overall portfolio play? So it's, I think, a far more nuanced approach to how you value and price MGAs versus brokers. And therefore, I think some of the models are very differently, but we always start with the underlying insurer profitability rather than what the P&L of the MGA is. The fact that they've managed to get a great commission deal or have huge profit commissions every other year is not going to be driving long-term value.
Yeah, okay, thank you. Well, we're drawing to a close now. There's only a couple of minutes left. So as a way to close the session, I wanted to ask you all one final question, which is basically, what will the successful MGA of the future look like? So Kate, as the newest MGA around, how do you answer that question?
I think it really brings back into focus some of the points that we discussed. I think it's very much, you have to be quite tech savvy, being aware of sort of current trends that are going on, whether it's your own digital platforms or looking to invest more in that AI model, to be very kind of customer focused. You've got to be agile and evolve to sort of customers' needs and demands, as well as staying up front with regulatory demands, and just make sure you're not sort of deviating too far from your core business knowledge whilst doing that. I think that you need to kind of leverage the data that we have to be able to stay in front of certain trends, but do that while you're still prioritizing regulatory compliance, data security, and that skilled workforce. And I think one of the things that perhaps a successful MGA needs to do is actually focus on the talent of the future as well, just because I think of the sort of the data set of a lot of people that work within the markets and how things set up and quite small agile teams. I think we need to start investing as well in the sort of the future of the people that are going to work in this market too.
Okay, thanks, Tim. Same question to you.
I'd agree with everything that Kate said there as well. I think also that the way that the model of MGA is working, I mean, historically, there was almost a complete overlap in some of the work functions carried out by an insurer and an MGA. And that led to very high expense ratios, which ultimately have been picked up by the customer, or a challenging profitability. And I think what we're seeing now is sort of bifurcation of that work transfer, but that involves a lot of trust from the insurer to pick their partners right and identify what should they be doing and what should we as MGAs be doing, and making sure there's as little overlap as possible. Now, clearly, FCA has called out co-manufacturing as an issue, and there needs to be sort of good work in there. But we don't want to be paying for someone's big brand or their marketing team or their premises. We want to make sure our expense base is lean, offers good value to our brokers. And ultimately, I think that will lead probably to more risk being taken, paradoxically, by the MGA than has historically been the case, with more ratchets, sort of negative PCs, maybe captive providers, different capital bases. So we are seeing a sort of, I think, a separation of the insurer and MGA model, going into slightly different areas. Something I could talk about at length, but I know we've only got 30 seconds left for Mike's answer. So.
Mike, last word to you.
No, again, sort of, I can't disagree in that. I think if I play it forward, I think it's the operational fixed cost thing, which I think will be very, very different for MGA. So I think they'll be able to concentrate even more on improved products, underwriting expertise, risk selection, all that through the case of the fact that operationally, through all the things we discussed around APIs and connectivity around sharing of data, that will be actually a hygiene factor, allowing them to be even better around the underwriting piece. That would be my sense.
Okay, great. Thank you. Well, that brings us neatly on to the end of today's session. So many thanks once again to Kate, Mike, and Tim for joining us. Thanks to all of you for tuning in and for asking the questions. Look out for the MGA performance report if you've not already seen it. It will be included in the next newsletter. And just to finish off, so you all know, at Insurance DataLab, what we do is track the performance of insurers, brokers, and MGAs across a range of metrics, incorporating underwriting and financial results, claims, solvency, customer experience, complaints handling, and all of that data is on our Insight platform. And if you'd like to know more, or would like a trial, just email me at dan@insurancedatalab.com. Thanks again for watching, and from Matt and me and all the panelists, goodbye for now.
Thank you.
Thank you.
Goodbye.
Thank you.